Hi, everyone. Thank you for joining us for our presentation, How Your Customers Can Be the Key to Better Company Valuation, presented by Professor Peter Fader, Francis and Pei-Yun Jia Professor of Marketing at the Wharton School of the University of Pennsylvania. My name is Muriel. I am on the higher education team here at Ivy Exec and will be moderating today's session. Before we begin, I have a few brief housekeeping items for our audience. First, all attendees are currently in listen-only mode. However, we do encourage you to engage in the session by asking questions to our presenter, which you can do using the question box in your GoToWebinar control panel. We will be having a formal Q&A session during the last 15 minutes, but you can feel free to send in questions anytime during the presentation. Additionally, we are recording today's session, so you can look forward to receiving a copy of the recording via email in the coming days. Now, I will pass it on to Peggy Bishop-Lane, Vice Dean of the MBA for Executives program at the Wharton School, to introduce today's speaker.
Thanks, Muriel, and welcome to today's webinar sponsored by the Wharton MBA program for Executives. I'm Dr. Peggy Bishop-Lane, the Vice Dean of the program and also an accounting professor. The Wharton MBA program for Executives is one of two ways that students can earn an MBA degree at the Wharton School. Our program is designed for mid-level and executive-level professionals in a variety of industries, fields, and functions, ranging from media to government, engineering to healthcare, and controllers to founders. The program is offered in an every other weekend format in both Philadelphia and San Francisco. Today, I'm pleased to introduce Professor Peter Fader, the Francis and Pei-Yun Jia Professor of Marketing, to talk about his most recent line of research. We hope that you find this not only interesting and useful, but that it also gives you a glimpse into how faculty bring their research into the classroom. Professor Fader teaches a quantitative marketing elective to second-year executive MBA students, and he also leads a global course on customer centricity in Sweden and Finland to that same group of students. He's the author of the CustomerCentricity Playbook and the winner of numerous teaching awards. Here today to discuss how your customers can be the key to a better company valuation is Professor Peter Fader. Pete, take it away.
Hey, thank you, Peggy. And good to talk to all of you. Good morning, afternoon, evening, wherever you might be. Appreciate your interest in this content. It's been a real source of passion for me. As Peggy said, it's part of my research. It's very much woven into my teaching. I'm really trying to spread the gospel about it, working with a lot of companies as well. Really exciting times for this emerging concept of customer-based corporate valuation. And I'm not even the star of this show. Yes, you're stuck with me for the next 40 minutes or so. But a lot of this is the work of my former student and co-author, now professor down at Emory University, Dan McCarthy. He rightly deserves top billing on this, basically taking a lot of the work that I've done over the years to figure out how to reframe it and add to it to make it relevant more for a financial audience. So let me get right into it, and then I'm going to give you lots and lots of specific examples. I'm going to name names. Publicly traded companies, tell you who's overvalued, who's undervalued. Keep in mind, I'm a marketing professor, and you shouldn't take stock tips from a marketing professor, but I am calling them as I see them, and I'm not shy about doing so. So if you think about it, we teach lots of courses on corporate valuation here at Wharton and basically any business school, and you can pick up any business publication that talks about how different companies are valued, and it often works something like this. That we're looking at all the different components that lead to overall valuation, try to figure out, what's the value of each of those different operating assets? And what about all the non-operating assets? And what about all that other financial stuff that in one way or another would add to or maybe detract from the overall value of a company? But the point is that it tends to be done in a top-down manner. We're going to say we're going to add all this stuff up. We're going to come up with some forecast for revenue. We're going to project that out into the future, do some discounting, and say that's the value of the firm. And I contend that that's the wrong way to do it, because I contend that not all dollars are created equal. You have to acknowledge that if we make a sale to a new customer versus the 10th sale to an existing one, the net present value of those customer touch points are different from each other. There's going to be different quality to those dollars. So my contention is, if we look at any of these operating assets over here, really the only way to value them, and let's think about branding. We're not going to say, well, we think that our brand is worth $2 billion. No, the value of the brand is nothing. It's zero, unless it helps you acquire more customers who might stay longer, who might interact with you more often, who might spend more when they do. So any operating asset is absolutely useless unless it's doing one or more of those things. And so my whole point over here is that the way we should be valuing companies is from the bottom up. Real specifically, if we can do what I just said a minute ago, if we can project how many customers we're going to acquire, how long will it be until they leave us for good? Over that horizon, how many transactions or other economically interesting activities will they have with us? When they buy from us, what stuff are they buying? How much are they spending? How much margin are we making? See, what I've been doing for 33 years as a Wharton professor is developing models to predict each of these different behaviors. And then Dan McCarthy comes along and says, wait a minute. If we can take each of those things and add them up, and then you see in the bottom line over here, do all the appropriate accounting stuff, and I'll claim no expertise, especially when my accounting colleague, Peggy Bishop Lane, is on the call as well. But if we can overlay the appropriate accounting treatment of these projected customer behaviors, well, that's the value of the company. That's what I'm going to demonstrate to you. If you're interested in this, as Peggy said, I teach this course on applied probability models in marketing. Just so happens that today is session 1. I'll be doing that at almost exactly an hour from now. Here's the syllabus for it. Very happy to share all that with you. The name is kind of either bland or technical. It has nothing to do with corporate valuation at all. And that's almost my point. And in fact, if you read the quote over here that I stole from Pierre-Simon Laplace, that if we can just understand different kinds of probabilistic processes, again, how many customers will require, how long will they stay, what will they do with that horizon, we can understand and forecast anything, including the value of the company. Now, as Peggy said, I do more than just technical stuff. I think it's really important to try to get managers to understand it as well. So I've written a bunch of books. So you can see this first one over here, Customer Centricity, the idea that not all customers are created equal. And if we can understand those differences, we can make more money than if we just focus on the average customer. Peggy mentioned the Customer Centricity Playbook, and I have 2 others on the way as well. So it's basically, it's coming up with these really good models, but also communicating to my students and to anyone who will listen why this stuff matters and why it would really change your perspectives on business as a whole. So, and it doesn't stop there, because it's not enough just to teach these courses. It's not enough just to write these books. I got to tell you, I put all this stuff out there and companies would still resist. Companies would still say, well, listen, our business is different, okay? We are constantly being disrupted. Our customers are unique. It's a bunch of bull. So a couple of years ago, I founded a company called Zodiac to basically take a lot of the models that I teach in this course and do in my research and bring them to life at full commercial scale. Let's work with retailers and gaming companies and travel and hospitality and pharmaceuticals and telcos, all kinds of different companies. And let's show them the value of each and every customer. Let's do the customer lifetime value thing for real in a very accountable way at full commercial scale. So if you look at this picture you see in the circle over here, I want you to stare at that. Okay, look at that picture. And what I'm going to do right over here is I'm going to reverse the cameras so I can actually track all of your eyes right now. Okay, I'm going to see where you're looking. It's very, very interesting. I can see where you're all looking. And you're noticing 2 things. Number one, that the distribution of customer lifetime value is not what you think. Because a lot of you have taken some kind of stats course or something like that, and you think, well, things follow a nice normal distribution. Well, there ain't nothing normal about customer behavior. The distribution that you see here is what we always see I don't care if we're talking about a product or service. I don't care if it's B2B or B2C. I don't care if it's some big, complicated technology item or some mundane, a low involvement consumer good. I don't care if it's in the US or if it's in China. When we wave our CLV wand and we see the value of each customer, and we pull it all together, this is what the distribution looks like. And it tells us two things. Number one, the vast majority of our customers aren't really that valuable. A lot of customers who are kind of one and done. It's true. But then you notice this bar on the right over here. That's where your eyes were going. And in fact, I could even go deeper, beyond your eyes. I can get inside your brain and I could see what you're thinking. You're thinking, what's up with those customers? What makes them different than everybody else? First of all, how are they using our product or service differently? That would be really nice to know. What features do they really focus on? What aspects of our ad campaigns do they respond most effectively to? What can we do with and for them to make them even more valuable? And how can we find aspects of them that distinguish them from other customers and acquire more customers like them? Which goes exactly to the point of book number one. Again, I showed you the cover of it. The key words aren't customer centricity, because that doesn't mean anything. The key words are right over here. The right customers. That not all customers are created equal. And if we can figure out who the right customers are, the ones with the most projected value, and figure out what makes them different, and figure out how to go to R&D and say, hey, R&D, come up with something for them. We can make more money in a sustainable, defendable, ethical way than just kind of aiming right down the middle at the faceless, nameless, average customer. That's my point, that we can really understand this and we can really use this to build the business completely differently. So at Zodiac, we were doing lots and lots and lots of different things. Once we have those CLVs, here's the 50 fun things you can do with them. And if you notice, most of these things are marketing oriented in terms of customer acquisition, retention, development. I'm a marketing professor after all, and that's all great and terrific. But if you notice, I'm talking in the past tense about it because just about 2 years ago, we sold the company to Nike. And it was a wonderful outcome in so many ways, and besides financially, but also the endorsement that it offered about the legitimacy of these models, the power that they offer, and how, a wonderful world-class brand like Nike would say, you know what? We want to understand our customers better. So it was a really great thing. But it also opened up new horizons besides, closing the door on Zodiac. If I go back to this slide over here about those use cases, I want you to look at the bottom line use case here. One of our clients at Zodiac was a private equity firm. And we were giving them all these fancy, gee whiz, interactive, let's draw a circle around these customers and send them one email and send a different email to those customers over there. We were doing all that kind of marketing stuff. And they said, we don't care. We don't care about any of that. All we want you to do is to give us the CLV of each and every customer of this digitally native men's underwear company or whatever, add all that up and tell us whether we should buy the company and what we should pay for it. And we said, well, yeah, we can do that. Long story short, after selling Zodiac to Nike, start up a new company over here, Theta Equity Partners, which Dan McCarthy and I continue to run to this day. I don't want to talk about it. I'm not here to pitch the company, but I am here to pitch customer-based corporate valuation. So I want to spend a little bit of time talking about that. First, I want to start with the research. So Dan and I have written a number of papers together, and here are the two main papers that underlie this stuff. And so you can see the top paper, and there's links to both of them as well. The first one, we look in the contractual setting. We're talking about any kind of subscription business. In this particular example, we're looking at Dish Network and Sirius XM satellite radio, but it's the same exact model. If you're talking about a meal kit, if you're talking about some enterprise SaaS company, if you're any kind of subscription setting, this is the model that you want to use to do the kind of bottom-up valuation that I've been referring to. And then in the lower right, you see the paper that we use in the non-contractual setting. Let me just say a couple of words about each. But first, let me just show off a little bit. It turns out there's this site called the Social Science Research Network, SSRN, when nerdy people like myself, whenever we write a paper, we post it there. There's roughly 1 million papers that academics around the world have posted. somewhere in the top 150. In other words, 0.001% or something like that is the first paper that I showed you. It is far and away the most downloaded marketing paper ever posted on the site, with nearly twice as many downloads as any other paper. Kind of gives you a feeling that it's more than just marketing professors reading it. Paper number 3 on the list is the other paper that I showed you. So here are 2 of the 3 most downloaded papers in the history of quantitative marketing science. Tells you that there's something going on over here. Let me just give you some highlights about each one. Again, I hope that you'll read the papers. Again, there are the links and so on. In paper number 1, we do this kind of bottom-up valuation for Dish and for Sirius. The math actually isn't all that complicated. It sure would help if you take my course. Let me just focus on the bottom line over here. Back in 2015, almost exactly 5 years ago, literally May of 2015, we did this kind of bottom-up valuation for each of these companies. And if you notice a couple of things over here. Number 1, the numbers that we got, in other words, the implied stock price by doing this bottom-up valuation, saying how many customers you're going to acquire, how long are they going to stay, how much are they going to spend, it's pretty close to what Wall Street's saying. So that's kind of a good sign that the people on Wall Street aren't completely wrong all the time. So it's pretty close. That's kind of reassuring that the markets are, for the most part, getting things right. But not always, you'll see. But what's interesting is that sometimes Wall Street's a little bit under, sometimes Wall Street's a little bit over. In the case of Dish, check it out. You see the red circle over there. We said that the company was worth about $64 a share. It was traded for $66. We said this company is overvalued. Not by much, but it's overvalued. And where is Dish trading at today? Well, I'm not sure, but much lower. And opposite thing for SiriusXM. So we said, again, pretty close, but to the extent that Wall Street is wrong, the company is worth more than what Wall Street is saying. And where is Sirius trading today? Higher. About 90% of the time, when we do one of these bottom-up valuations, the stock tends to move in the direction that we suggest. In other words, over time, Wall Street doesn't immediately recognize the value of those customer assets. They don't recognize that you've just acquired a bunch of awesome customers who are going to stay with you for a long time. But eventually, those customers do show up as enhanced revenue and profitability. And then Wall Street says, this is good. So in many ways, this is just a leading indicator by breaking revenues down and understanding the quality, the source of the revenue as well. Let me show off a little bit over here. Back in May of 2017, this is 2 years after we wrote the paper, I gave all of the data to the students in the same course that I referred to. And I said, I want you to do the forecast for Dish. So here we go. Here's May of 2017. That quarter, Dish announced 547,000 new customers acquired. The consensus estimate on Wall Street, as you can see here, was 13% higher. And that week, Dish lost $1 billion of shareholder value. Oops! Well, who wasn't fooled by it? Our students. So a project that I had given them months earlier, I said, here's all the data, project it out. And when we looked at the forecast across my 156 students, took the simple average across them, no funny business at all. What was the average? 550,000, within 0.5%. It's not that hard, folks. It's not that hard. It's just unconventional. And so this stuff really works. And not only does it give you good forecasts, like I said, it also gives you some really good insights too. So let me turn to the next example over here. This one you're going to find amazing. So this is now the non-contractual example. Let me set the stage for you. Dan and I wrote a paper basically doing all the math and setting it all up. And we have to look around and find publicly traded companies that would actually reveal the metrics that would let us do this kind of outside-in, bottom-up valuation. And we found 2 companies that just happened to provide exactly the right metrics, Wayfair and Overstock. So again, I'm going to spare you all the technical details, but we basically build a model for how many customers you're going to acquire, how long will they stay with us. And that's really tricky in the non-contractual setting, because it's not like they cancel their subscription. No one calls up Wayfair and says, I'm never buying from you again. They just stop. So we have to infer whether customers are alive or dead. That's tricky, but we can do that. And while they're alive, how often are they going to purchase, how much they're going to spend, and so on and so on and so on. It turns out that those companies provide just enough data publicly not to us as academics, but publicly. They just put out their earnings numbers a couple of days ago, and there's the numbers. It's great. We can do this kind of thing. So I'm going to cut to the chase over here. We build these models for Wayfair and Overstock through May of 2017. This is a newer paper. We basically show how well the models fit on historic data up to that time, and then seeing how well we were able to capture how many customers they acquired, how long they stay, how much they spend, and so on. We can then project, we can add all that stuff up and then project revenues ahead. This is what it looks like. So you can see that dashed line, that's May of 2017. The model's like perfect up to that point. And we say, here is the future for Wayfair. And if you look at, and by the way, we acknowledge that our model might not be perfect. So we basically come up with different variations of it. We tweak the parameters a little tiny bit and say, oh, maybe the acquisitions were higher. Oh, maybe the retention is lower. So we come up with several hundred or several thousand variations on the basic best guess model to be able to come up with a range of possible forecasts. And that's what you're looking at right over here. And if you notice, every single one of them paints a fairly bleak picture. This company is going to crash. See, the problem is they're an acquisition machine, but not a very well-oiled one. They're losing money on every customer they acquire. They're spending far too much on acquisition, and their margins, which are negative, are just becoming worse and worse and worse over time. It's actually pretty obvious, okay? So we're not exactly sure when this crash is going to occur. You know, it could happen tomorrow. It could happen 10 years from now. But every single scenario we look at, even the most optimistic one, paints a grim picture for the company. So if you go back to the slide where I showed you where we posted that paper to SSRN, the date on it, if you look very carefully, was September 21st, 2017. That day, Dan and I finished writing up the paper, having this analysis through May of 2017, posted it on that website. That was that. I mean, the paper got published a year and a half later. But let's see what happened to Wayfair right after we published the paper, literally the day we published the paper. Dan posted it to SSRN at 10 o'clock on the night of the 20th. And what happened to Wayfair the very next day? The biggest drop in their stock price in years. People started noticing this paper written by a couple of marketing professors, started tweeting about it, lots and lots of press about it. In fact, here's Jim Cramer, Mr. Mad Money himself. Jim, what do you have to say about this? Jim is being shy. Jim, what do you have to say about this? Come on, Jim. You can talk to us. Jim?
Say the prolific left, he's really into this one, struck again when he tweeted his support of an academic paper published by professors at Emory in the University of Pennsylvania, calling it the smartest piece ever written on Wayfair. It did the job, causing Wayfair to plunge from 83 to 70 as of today. What was so devastating about a high-level academic paper? The professors tried to come up with a way to pin a value on Wayfair's current and future customers based on how much they make from these customers versus how much they spend to acquire them.
Sound is off. I hope you're able to hear it. But just to kind of to summarize, in case you were having any audio issues, what Jim Cramer said is that these couple of marketing professors proposed to pin a value on Wayfair by saying how much they get from each customer versus how much they spend to acquire them. Basically, let's look at the lifetime value of each customer, add that up, and say that's the value of the company. And here we go again. I'm going to look inside your camera. I want to get the look on each one of your faces. And your look on your face right now should be something along the lines of, duh. That's how every company should be valued. And that's exactly our point, is that this is the right way to do valuation. We're doing it in a very conventional way. We're projecting revenues in a discounted manner. But the difference is we're projecting the revenues the right way by recognizing the components of it and the quality of it as well. So let's just kind of fast forward a little bit and see what's happened to Wayfair since then. So check out this graph and compare it to those red lines that I showed you. You saw that big drop in the stock price? That's what appears to be this little bitty drop in late 2017. Because look what happened to the company's stock price over the 3 years since then. But if we go back to early last year, their stock went up to 170 something. And after their last earnings report in late February, they crashed down to about 20. Ka-ching! Ka-ching! Yeah, oh, except for one thing. That's right. There's more. Yesterday they closed at 180. What? It's the most amazing thing. And if you want to read about it, I strongly encourage you to check out this LinkedIn post from Dan McCarthy. See, what's going on is that these days, if you need to buy furniture, they're the only game in town because every furniture store is closed. As we spend all of our time locked into our houses, we feel the need to rearrange things a little bit. Wayfair is riding high right now. But as Dan says, when you break it down, look at the quality of the earnings, it's actually very, very bad. In Dan's own words, it's actually a sugar high. It's something that will probably all completely disappear when people can go outside and when furniture stores can reopen again. It's actually really, really low quality revenue. Lots and lots of revenue, but truly losing money on each and every customer. And based on that track record, probably not doing a lot to hold on to those customers, you know, when times get better again. Now, I don't know. You can look at this picture over here as some kind of Rorschach test and say, the professors were right. Look at that trajectory. Or you can look at the current stock price and say, the professors are wrong. You decide for yourself. I just think that we got kind of the science and the math going for us. And by the way, this is, in terms of comparing the actual stock prices for whatever it's worth to our estimates, this is far and away the worst case we've ever had. It's been really interesting to look at lots of other companies as well. So for instance, through Theta, we did one of these exercises for Lyft when they announced their IPO a couple of years ago, basically saying the unit economics are actually pretty good. The lifetime values of the customers have a very favorable distribution. Remember the picture I showed you before with the big green bar on the right? They got a nice green bar on the right, but the problem is all their overhead, all the fixed costs and all that stuff are terrible. It's not a great company to be buying stock in. Of course, we've proven right about that. And how nice is it when the Financial Times, the FT itself, says the best analysis that they see being done by a couple of marketing professors. If you're interested, here's a link to a webinar that Dan and I did last month, where we actually go through the Lyft and Wayfair analyses in a lot more detail. But we're just starting on the revolution over here. In the previous issue, the January-February issue of the Harvard Business Review, we have an article, kind of a companion piece to one written by Rob Markey. I don't know if any of you recognize that name, but you certainly know who he is. Rob Markey is a senior consultant at Bain, and he's the guy in charge of all the Net Promoter Score stuff these days. And he's a big fan of the stuff that we're doing. He recognizes that the Orange's Net Promoter Score in many ways was kind of a leading indicator of what a company's profitability would be, very much aligned with the behavioral metrics that we're talking about. And so if you're interested, you actually get some links to both of those HBR articles at this link that you see on the screen over here. But wait, there's more, because if you look at that link, not only does it say HBR, it also says FASB. FASB, of course, being the Financial Accounting Standards Boards. And so basically, Rob and then Dan and myself have written letters to FASB basically saying, you know, in this day and age, given the quality and quantity of data that's available, given the kinds of analyses that companies are already doing, the kinds of analyses that investors want to do, that investors should be demanding that their potential acquisitions or investments do for them, that a number of these kinds of metrics, you know, how many customers have we acquired, how many of them are active, how often are they buying, all the stuff that I've been talking about should be required disclosures for publicly traded companies. So here's a letter that we wrote to FASB just a couple of months ago, basically saying, hey, FASB, you know, it's time to kind of change what we disclose. Again, I'm going to be careful about this with an accountant in the room over here, but they're listening. and we actually just had a conversation with them a few weeks ago saying, tell us more. How should these things be defined, and how should they be reported, and what caveats should there be? Look, if this were to happen, it is still years away. But the conversation, at least, is happening. And I find that just very heartwarming. I'm going to close things over here by coming full circle. I really believe in this stuff, this customer-based corporate valuation. In fact, I now own a trademark on it as well. So if you use those words, you owe me a nickel. Literally, we have those words. We have the paperwork right here. But I'm not a finance guy. I'm a marketing professor. And what I've discovered in these last few years, thanks to Dan McCarthy, is that if I want to win over a company to do this customer centricity thing, that not all customers are created equal, and if we can figure out the difference across them and figure out how to leverage them and acquire more customers like the really good ones, we can make more money in a, whatever I said, sustainable, whatever way. I really do believe that stuff. And so in many ways, the way to start the conversation is with the CFO. If we can win over the CFO, if we can show her that we can help her do her job better through this idea of bottom-up, custom-based corporate valuation, then winning over marketing and operations and R&D and all that sort of thing, that's going to be easy. So I'm thinking about it much more holistically and using these models and perspectives not only to do valuation better, but to meaningfully create alignment across the entire organization. So here is my very last slide. If this stuff intrigues you, whether you agree or not, if you're curious to learn more, I strongly encourage that you follow Dan McCarthy on Twitter and on LinkedIn, posting stuff about it all the time. I am too, but half the time I'm just retweeting his stuff. I mentioned those two papers, which again, just showing that the academic research that we're doing not only translates into the classroom, but has real, meaningful, real-time impact on industry. And if you want to know more, again, I'm not here to sell anything. Well, I'm here to sell Wemba, actually, but but there's other case studies and things on the Fate Equity site. There's other books you can read. I'm going to leave it at that. I would love to get questions, comments from all of you about what you think about this stuff and just, what your kind of visceral reaction is, questions, all that sort of thing. Let me toss things back to whoever I'm tossing things back to. And let's get into some Q&A here.
That would be me. So thank you, Peter, so much for this very insightful and very interesting session on customer centricity. We have a lot of questions coming in, so I'm just going to dive right into it. So we're going to start off with a question referring to your earlier slide on Wayfair. A question from Renil is asking, how are you calculating their CAC and LTV? Is that from a publicly available data? And then as a follow-up question, what is an ideal LTV to CAC ratio?
Okay, so let me start with the last question. What's the ideal LTV to CAC ratio? I hate that question. It's a bad question. Don't ask it. And you should know better than that because I showed you the distribution of the CLVs earlier. And if you calculate an average CLV, it's kind of meaningless. Okay, it doesn't tell you anything about the spread of the customers. All the action is in the variation. So what I want to know is how those CLVs vary. I want to know, is there that big spike on the right? How far out is it? How high is it? And unless I have things like that tell me about the spread of the CLVs, it's not all that meaningful to me. So that last question, trying to take it all and just collapse it down into a single LTV is a bad thing to do. And by the way, most companies that talk about the LTV to CAC ratio aren't even doing it the right way. That's a whole other story. So how do we do it? Well, it turns out, I mentioned this very briefly before, Dan and I wanted to figure out what's the right way to do this kind of outside-in, bottom-up LTV calculation for publicly traded, non-contractual, non-subscription companies. We looked at a lot of different metrics that some companies have revealed from time to time. And we have an entirely separate paper, not even published, where we looked at every different combination of metrics and asked ourselves, which combination of metrics would actually give us the best insight into the quality of the overall customer base? Or in other words, if we had the raw transaction log data from a company and we ran the models that way, which is always ideal, But if we're working with a company that we don't have the raw transaction logs, what metrics would let us come as close as possible to what we get with the raw transaction logs? And it turns out, by sheer coincidence, or maybe proof that there is a God, Wayfair happens to reveal exactly the right metrics. How many customers have they acquired? That's one. The other would be how many active users do they have in any given period of time? I forget if they reported quarterly or annually, it doesn't even matter. But how many people over this regular slice of time have made a purchase with us? And then QTO, quarterly total orders. So if you tell us the breadth of the customer base and the depth of the customer base, and you give that to me over, let's say, I don't know, 10 to 12 quarters or more, and then I do the math, and it's all covered in those papers, I can come up with not only an estimate of LTV, but the distribution of the LTVs almost as accurately as if you had given me all the raw customer data in the first place. And even some of these other companies, like I mentioned, Lyft, and some of the other companies that we've looked at, Slack, Revolve, Farfetch, a bunch of others. It just so happens that either on a periodic basis or very often when they're about to go public, when they're filing for their IPO and they put out an S1 filing, very often companies in that disclosure will give exactly these kinds of metrics. And so we can kind of reverse engineer those transaction logs really, really, really well. And that's kind of our point, is that those numbers shouldn't only be put out there as trophy metrics once in a while. They should be put out there every quarter. So there you go. There's some questions, some answers to the LTV question. Well, get some more.
Great. Now onto a question from a couple of people actually. You talk about a lot of B2C cases, which then makes a lot of sense, but they wonder if the same methodology can be applied to B2B businesses and what impact do they expect to see in B2B business?
You know, it turns out that B2B versus B2C distinction is largely artificial. Look, I understand that the business practices are totally different. The language that we use, totally different. But when you break it all down to the stuff that I care about, here we go again. How many customers are going to acquire? How long are they going to stay? What are they going to do with you over that horizon? How much money will we make from them when they do that? Those distinctions disappear. And I mentioned one of the companies that we've looked at is Slack, okay, so an enterprise SaaS company. And I defy you to look at the kinds of metrics that Slack puts out compared to the metrics from a Lyft. You can't tell the difference. You couldn't tell me which one was the B2B versus the B2C. And so whether it's through the academic research, whether it's through some of the commercial stuff, working with lots and lots and lots of B2B, and now admittedly, most of the companies that we look at are B2C, but that's not because the models work better there. That's only because investors tend to have that same bias. That, oh, this stuff will be great for B2C. Not sure if it'll work for B2B. Nonsense. But in the cases where we have looked at B2B, and we actually completed a very nice B2B project very recently, I won't say anything about the company because it's a big player in its field, and the patterns are the same. And you know what? To the great credit of that company, not only did they use the analysis as a way to find out what they're really worth, but also they're using it as that same kind of leverage to start having the customer centricity conversation. So, you know, with their partners down the distribution channel, how they can figure out how they differ from each other and who they should be showing more favoritism to and all that sort of thing. So they're getting in this really holistic way. So honestly, to me, the biggest distinction is not B2B versus B2C, overrated. The biggest distinction is it a subscription-oriented business or not? Because there it's quite a different model. And that's why we have a separate paper for each one. But the basic patterns, B2B, B2C, no big deal. And happy to elaborate more on that. Great question.
Wonderful. Now a question here from Sam. How would the CLTV approach factor in the switching cost of moving away from unprofitable customers to more profitable customers?
Well, that would be baked into the metrics. And so, Sam, it allows me to raise another point that I haven't raised, but it's really, really, really important. When we do these analyses, we never do them for the company as a whole. That would be misleading. In the same way that revenue is misleading, the customer base is also misleading. So what we do is we break it down cohort by cohort. We look at the customers who we acquired in Q1 2014, Q2 2014, Q3, Q4, Q5. We look at each tranche of customers who were acquired at a different time, or perhaps through a different channel, or through a different campaign, or from a different geography. So we'll work with companies to figure out what's the right way to cohort your customers. But the time dimension is always the most important. And what we find, and why it's so important to do this, is because not all cohorts are created equal either. And so we will see some very clear cross-cohort dynamics. And it can go in different directions, but most of the time, like 80% of the time, they tend to get worse. Like each group of customers is a little bit worse collectively. There's always some good ones in there, but collectively they're worse than the group of customers we acquired in the previous quarter. So we'll break things down on a quarter-by-quarter basis. If a company's doing a good job, if they're building those switching costs, if they're acquiring the right kinds of customers, they're getting people to spend more money, we'll see that hey, this cohort is better than the previous one. And we'll take that into account, and then we'll probably project that the next cohort will be even better. So we actually recently worked with a private equity firm. If you looked at the customer base as of now, it was great. It was terrific. Very healthy company, valuable. But when you look more carefully at the cohorts, you notice that the most recent cohorts were substantially worse than the ones that they had been acquiring before. And that's a real problem, because so even though the customer base is healthy, the customer acquisition isn't working as well. Now, A, maybe they could fix that. Let's go in there and figure out the tactics to try to get back on track. Or B, maybe we've already overfished the waters and there are very few other good customers, or our competitors have caught on. So it's really important to look at these cross-cohort effects to see how you're doing overall, but also how to gauge the different kinds of marketing or product or operational activities that you're doing. Hope that helps. Next question.
I was muted there for a second. Jack has a question on for earlier stage companies, with limited customers, how practical is this approach, and how maybe some best practices for them to use?
Yeah, these are so good. It's deceptively good. Here's why. If you run the models on an early stage company, they're going to look really good. The models are going to fit perfectly. You can say, whoa, this stuff is awesome. But here's the problem. It goes back to exactly the point that I was just talking about with respect to Sam's question. There's going to be cross-cohort dynamics. And those early cohorts that you see from this startup, the friends and family who line around the block to buy that new thing aren't typical. And so very often when we look at a company early on, it's getting its best customers early. And so you can run the models, but you're going to get a deceptively good outlook on what it's all these metrics and revenues are going to be. So my rule of thumb or rule of fingers is that I want to have at least 10 to 12 quarters of data before I really, really trust these valuations. I trust the models, but I don't trust the valuation until I start to see these cross-cohort dynamics in action. I want to see basically the quality of the cohort start to decline, which again, it's not universal. That's what tends to happen. And then as they start to level off, and so as quarter number 10 customers are a little bit worse, but not that much different than quarter 9, I can start to project that stuff out. But if I do it too early, there's a good chance I'm going to get a misleading read, either because the customers are getting worse or because they're getting better. So usually I'll say, give me 10 to 12 quarters before I'll really trust these valuations, because I want to be held accountable. And the last thing I want to do is just say, hey, look, the models are good, bye. I want to make these long-run projections, as you've seen me do here. And for very early-stage companies, it's just harder to do that. There's just too much uncertainty. There's too much settling in that has to happen. Great question, though.
Great.
No, back to you.
Yeah, thank you. Well, so speaking of long-term models, Philo here has a question. Your Wayfair model forecasts 20 years into the future, and you had mentioned that you had a range of parameters, but do you think the model adequately covers potential corrective actions? And a fun example that he provided was, what if someone from Wayfair is on this call right now? What are your thoughts?
Well, let's again start with the end. I hope they are on the call. I have nothing against the company. In fact, I give them a tremendous amount of credit for disclosing the metrics that they disclose. And that's incredible. I wish every company did that. And that, I mean, that degree of transparency is amazing. So they're not lying to anyone. I'm not saying that there's anything, illegal or unethical going on there. It's just investors are stupid, and they're basically looking at hey, revenue's quadrupled over the last quarter, and instead of saying, yeah, but why? Is it quality or quantity? So nothing against Wayfair, and I have reached out to them and said we need to talk. And in some cases, some of the companies where we had some grim things to say about them did listen, did ask. A great example is Blue Apron, the meal kit company. Dan did analysis on them when they went public back in 2016, I guess it was, and it was really ugly. But they said, well, tell us more. Tell us why. What can we do? And so I hope that they would listen. But to the main part of your question, yeah, that's a pretty wide range of scenarios. In other words, some really good best cases and some really bad worst cases. As you saw in that big jiggly jaggly red squiggle, they were really different from each other. But I'll tell you what, even under the best case scenario, the single best case scenario that we had going on there, the highest the stock price could be, and again, this was 3 years ago, but it hasn't changed much. The highest the stock price could be is $57 a share. So the fact that they're trading up there near 180, it's completely out of line. And by the way, we actually redid the Wayfair analysis about a year and a half later. We should do it again. Note to self. And we did it a year and a half later and found that their projected stock price was within pennies of what we had forecast a year and a half earlier. So the numbers are actually pretty stable. And therefore, the range of kind of outcomes that we showed you is pretty generous. Yeah, they're somewhere in the range that we projected, and they're just way too high right now. And again, nothing personal, Wayfair. It's great that your investors think as highly as they do, but they're probably mistaken. More questions?
Great. I hope they're on the call as well. Since you mentioned Blue Apron, and to talk about subscription-based business in general, Pete has a question on, have you found differences in LTV for those who are engaged in long-term subscriptions versus month-to-month?
Let me think. Well, I'm going to give you the general answer, Pete, which is we haven't done a full meta-analysis yet. In other words, we've done this kind of analysis probably for, I'm going to say, 100 companies. But until we've done more over a broader variety of sectors and over a broader variety of economic conditions, I don't want to go out on a limb yet and say, here's where we see overvaluation, here's where we see undervaluation. Again, I'm a sciencey kind of guy, and I don't want to jump to conclusions unless I'm really comfortable with them. I will say this though, nothing stands out, and so I haven't yet seen anything systematic for subscription-based versus non-subscription-based. I haven't seen it. Like for instance, a lot of people look at the Wayfair example and say, aha. You can blow holes in all those digitally native companies. They're all made out of hot air. Well, that's not true, because a lot of these digitally native companies are good. A lot of them are actually have wonderful unit economics. Again, working with a lot of private equity firms, they're saying, you got to buy this company. It's amazing how good their customers are and how much better their cohorts are getting. So we haven't really seen anything systematic. Half the time we see companies being overvalued, half the time we see them being undervalued. Dan McCarthy, in a kind of a new, he's sort of done a bit of that meta-analysis, and he said, suppose we create a stock portfolio of the companies where, that we, the public companies that we've analyzed. If you look at the returns from that, and it's actually pretty good. And it's actually, I even asked about that recently, even with all the COVID stuff going on, it's actually held up nicely. So you could ask him for that. I don't know if he's sharing that, but no, he is. So yeah, nothing particularly systematic yet, but I'm really, really interested to do that analysis. And by the way, really interested to take these models and extend them to a situation where instead of just doing them for one company at a time, we could do them for a whole sector all at once. Like, let's look at the telco sector and do it for, Verizon, AT&T, Vodafone, all at the same time. to take the limited data from each one to basically come up with better statements about all of them. So we have lots and lots and lots of research that we're still doing, and I think some of the conclusions that you're looking for will be coming. I'm not holding back. It's just too early to say anything like that.
Okay, great. So speaking of big disruptive forces, I actually have a question here from Scott wondering, what are your thoughts on the notorious tweet from Tesla CEO Elon Musk when he allegedly tweeted, and I quote, tweeted 14 billion off the company? What are your thoughts?
I love that question. I don't have an answer. If Tesla were to disclose the kinds of metrics that we want, we can give it a try. But again, I'm not out there just looking at companies and just saying, well, I like this one, I don't like that one. I do like Tesla, two of them, but that doesn't say anything about the company necessarily. Now, Tesla would be a tough one, because if you think about the kinds of metrics that I'm looking for, ideally, we'd want to see repeat purchase metrics. And so again, I might be an example of one, but there probably aren't that many yet. And so all the more reason, and also the company, its customer base is still taking shape, not quite a startup, but I think we would need to wait a little bit longer to give people more chances to make those kinds of repeat purchases, to see how the cohorts shake out. And of course, for them to disclose that data, for us to say anything specific about it. But I would love to do so, just to see what's going on there. It almost pains me when companies do make statements like that, and I have to kind of sit on my hands, because I just don't have enough information to agree or disagree. But that's that's the kind of the blessing of doing things in this kind of rigorous scientific way, but also the curse of it.
Great. My segue to another very big company, very well-known company, question from Nithya. How would you estimate CLV for a large company like Alphabet? The customers of Alphabet include many thousands of small, medium, large businesses. And the CLV of these advertisers with Alphabet is very much dependent on their own businesses. What are your thoughts?
Yes. Well, first of all, thank you. Wonderful. You're right. Too often when people ask me about these kinds of companies, they're thinking about the customers as being you and me. Look, you and me, we're not the customers of Alphabet. We're the raw material. The customers are the advertisers. So it's really good that we have clarity on that. And if we looked at that, Alphabet's it's a big mess, because they're doing so many different things. But if we took a more focused company that's just basically selling advertising, and that is its business model. So if we looked at, a Facebook or a Twitter perhaps, and if we look at the advertiser level data, don't tell me how often people are tweeting or this or that. But if we said, how many advertisers will we acquire? How long will they continue advertising with us? How often do they do so? And how much do they spend? These models work quite well. Now, they're going to work better for a company that's kind of singular in its focus, like Facebook or Twitter. For an Alphabet, it could be trickier, because maybe for the Google part of the business, it might be a little bit cleaner, but they're just doing so many different things, so many different sources of revenue, so many weird non-operating assets that would be harder to put a price tag on. So that would be much more challenging. I'll be the first to admit it, because the kind of data that might be available, whether publicly or not, might not fully capture what they're doing and the kind of customer asset value that they're building. So that would be a tricky one. And there'd be others too. Again, other large conglomerate type companies that if you can't break them up and do them division by division, that would be a problem. But you know what? I would contend that the same problem exists even if you try to do traditional valuation, because you're getting this revenue stream and it's this mishmash of lots of different sources. So even if you're not doing it the bottom up way, good luck forecasting that. So, I think that's always going to be true.
Great. And then sort of a twist on that question, we have one here from Dr. Angshu. If a company operates multiple business verticals across countries and some customers use one vertical versus others, then in that case, how would you adapt your model and valuation approach?
So these are conversations we'll have with companies. So if they're truly separate businesses, okay, so we operate, in Asia Pacific, we operate in the Middle East, we operate in Europe, and so there's no crossover of customers there, then these are cohorts, right? We'll basically do the analysis for each one, add them up. I'll tell you a story. I won't say who it is, but a giant e-commerce company came to us, felt that they were grossly undervalued by Wall Street. And they said, we have all this sticky customer loyalty. Can you help us show our investors, what it looks like? We did our analysis on that basis, geographically. We found out, first of all, that Wall Street was spot on, that the valuation on them was pretty appropriate. But we did see differential sources of value across those different geographic areas. And then it led them to do this kind of introspection about why are we seeing much more value over here than over there? How are our practices different? How is customer behavior different? What more can we learn from there to carry over to the other regions? So yeah, we can just aggregate the regions together, or do them separately and aggregate the results together. But by doing them separately, not only does it give us better statistical results, but also gives us better insight that we can use for operational purposes. Now, let me give you a twist on that question. Suppose you are a multi-product company and you're selling different stuff to the same customers. Then it gets tricky. I mean, let's say you're talking about, I don't know, an Amazon. And you got your books department, and you got your music, and you got your fashion, and you got your office supplies or whatever else. So you could do the analysis sector by sector and then add them up. But it's not quite right because we're not getting a holistic view of each and every customer. And it could very well be that there are some customers who are buying across these different areas. So I prefer to kind of, in that case, look at it more holistically and saying, we got customers regardless of what they're buying, and let's kind of then build it up that way. And by the way, it have huge implications for the strategic customer centricity stuff as well, because when we see that green bar on the right, all those really valuable customers, we'll start to ask ourselves, what categories are they buying in disproportionately more or less than our other customers, and then use that for how we should be allocating resources. So there could be some complexity there when there is some overlap like that, but we can deal with it, and we do.
All right, awesome. So to close out our Q&A session, we just have one more question here from Aiden. Any suggestions on securing buy-in from senior management to establish a more customer-centric organization?
That's great. So it goes right back to where I was at the beginning of our conversation, where, for most of my 30-odd years here at Wharton, building these really great models to be able to predict this and that and the other thing, and go into companies and say, here, use this. And they'd ignore me. And that's why I started writing these books about the sky is falling, you're doomed to fail, repent, and I will show you the way. Okay, well, it's a little dramatic, but to basically say there are different ways of doing business out there, and if we can recognize the differential value of our customers, we can make more money in a sustainable, whatever, dependable, ethical way. And I found it really frustrating, even after writing the books, because I would get the marketing people on board. We're all in marketing. And then they'd turn to the rest of the organization. People in finance would roll their eyes and say, it's just the clowns in marketing, doing that crazy flavor of the month thing. And that's why the CBCV stuff is so powerful, as I mentioned. These days, even though I'm a marketing guy, I want to start with finance. But if I can win over the CFO, then the other parts of the organization are going to fall like dominoes. So that's one piece of it. The other piece is corporate culture. Some companies are just set up to do this, and others aren't. I will be the first to admit that I know nothing about corporate culture or organization design. I'm just a number cruncher. We got lots of other good faculty here who teach that stuff. So I mentioned I'm writing a couple of other books. So right in front of you, you're looking at book number 1 and 2. I'm working on book 0, which is a customer-based audit, which is, what does the data look like even before we start running the models? That one's going to come out in about, a few months or a year. But book number 4 or 3, whatever, but the 4th book is going to be the 5 C's, creating a customer-centric corporate culture. And I think figuring that out and coming up with templates for how to do that, coming up with a kind of a scorecard to know who's doing it well or not, and recognizing what's uniquely different about a customer-centric corporate culture versus a product-centric one, there will be some differences. So it's way too early for me to say anything, but I do recognize that figuring that stuff out is at least as important as having very nice statistical models. But, why not have it all? So, I've been doing a lot of work in this area. I'm not declaring victory just yet. Right now, I'm making this whole big deal about starting with the CFO. But who knows? 5 years from now, I might be singing a different tune because I'm very much on a learning journey myself. I hope that many of you are too. And I hope that you can see that the kinds of resources that we offer here at Wharton through our executive MBA program and otherwise can really help you not just learn business as usual stuff, but learn the real cutting edge stuff that you would just not learn otherwise. You can't just, pick up a business book and figure it out. And I hope that all of you will continue on your learning journey. And if any of you, are interested in this particular piece of it, you got all my contact information there, and I'm very happy to keep the conversation going.
Fantastic. Thank you so much, Peter. This was a wonderful session. It was such a pleasure having you. And thank you to everyone for joining our session. We hope you, stay safe, stay well, and hope to see you on future webinars as well. So thank you, everyone.